Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. Starting from this week, we are going to discuss Chapter 6. There are two key learning objectives for Chapter 6. The first one is the calculation of net sales, and the second one is the uncollectible accounts receivable, or what we call bad debts. Let's get started. In this video, we are going to discuss these items: credit card sales, sales discounts, sales returns, and net sales. Let's first talk about accounting for net sales revenues. In the prior chapters, we discussed accounting for net sales revenue and the revenue recognition rule. When we talk about revenue recognition rule, we talk about when we should recognize revenue, which is when revenue is earned. So the revenue recognition principle requires that revenues be recorded when the company transfers goods or services to customers and in the amount that the company expects to entitled to receive. We are going to talk about two types of companies. The first type is called the sellers, or merchandising company, or manufacturing companies. Those companies would produce goods or purchase goods in a wholesale price and then sell it in a retail price. Either one of them, sales revenue is recorded when the title of the goods and the risk of the ownership is transferred to the buyer. Here is an example where we use the shipping terms to explain how recognition of revenue would be used in reality. So let's assume we are a factory. We manufacture some like ketchups, right? And then we are going to sell it to our customers. Now, there are two types of terms that when we deal with the shipping company. One is called FOB destination, which means the goods are not considered transferred until it reaches the destination. Another term is called FOB shipping point, which means when the goods goes to the airport or goes to the harbor, started to be shipped, then it's considered transferred. So you can see these are two different types of terms determining when the goods are in legal terms has been transferred to the customer. So when we think about sales revenue recognition, it has to be recorded when the titles and risk of the ownership are transferred to the buyer. This means what? This means if we have a term with the shipping company where we use FOB destination, the title of the goods are not changing hands until it's delivered. So you cannot recognize revenue until the goods is delivered under FOB destination. On the other hand, if you're using shipping points, it means the title of the goods changes hand at the shipping date. So whenever the shipping date arrives and we ship our goods to the airport and something like that, that means we already transferred the title of the goods in the legal terms. So at that point, we could recognize revenue. So you can see when you could recognize revenue is really depending on when the good is transferred. When we say transfer, it's the title of the goods and the risk of the goods are transferred. If a company is a service company do not sell goods, they provide services. So service companies most often recorded sales revenues when they have provided services to the buyer. For example, suppose I am Becker's CPA Review, right? So now I'm teaching you a lesson. I cannot recognize revenue when I receive your tuition. I have to recognize revenue whenever I finish my lesson and count the parts of your tuition towards that lesson that I provided. So you can only recognize the portion related to the service you have provided. That's the idea. In summary, revenues are recognized when it's earned. Now let's take a look at some tools that firms use to boost their sales. There are credit card sales, discounts, allow customers return, and so on. So companies use varieties of methods to motivate businesses and customers to buy their products and make payments for their purchases, including allowing customers to use credit cards, providing business customers direct credits or discounts for early payment, or allowing returns from all customers under certain circumstances, which you and I see every single day. So let's first talk about credit card sales. Credit card sales provides a lot of benefits to the manufacturer or the seller. For example, it increases customer traffic, it avoids the cost of providing credit directly to the customers, so on and so forth. But using credit cards is related to some cost, right? There's no free lunch. So there is a fee related to credit card use, and the fee is called credit card discount. So that means our company, when collecting money from the customers using a credit card, our company has to pay the credit card company a fee. So this fee would reduce the sales revenue, of course, because in order, for example, in this example, we give $3,000 credit card sales to our customers, right? In order to generate the $3,000 credit card sales, we basically have a cost related to that, which is the 3% credit card fee. So 3% multiplied by the $3,000 equals to $90 credit card fee. That should be subtracted from the sales revenue. That would give us the net sales reported on the income statement. Another way to boost sales is to provide credit sales to our customers. For example, I'm selling books. I know my customer has not received their financial aid, so I'm going to wait until they get their financial aid and paid me. Now, this increases my volume because for those people who could not afford a book on a certain date, they could now, because it's just a matter of time. I know they're going to pay me, but it's just a matter of time. So that is called credit sales. Some of the companies would encourage customers to pay early because the longer it delays, the less likely the payment is going to be collected. So usually business will provide some discount called sales discount related to early payment. This is a very common term that you would see in the credit sales contracts or the business terms. It's read as Ch6-1 Net 30. What does this mean? This means if the customer who has credit sales from us can pay their full payments within 10 days, we give them 2% discount. Or if they can't pay it within 10 days, they would have to pay it in 30 days in full. So that's called Ch6-1 Net 30. Now, if the customer didn't pay us earlier, it's between 10 days and 30 days, 11 days and 30 days, then they have to pay the full amount, no discount. But if the customer pay us earlier, we'd have to provide 2% discount. Now, whether the customer would take the discount or not to take the discount, depending on whether the customer will save money by borrowing from us versus borrowing from the bank, right? This is a business basically decision. So if a customer made a $100 purchase from us, if they pay back within 10 days, they got $2. That means the net sales for us would be $98, $100 subtracting for the $2 discount. All right, next. We will allow customers to return. Now, this is a law in the US, right? Customer needs to have certain degree of satisfaction. In some of the countries, it's not mandatory. Companies just provide free returns to customers just to attract more customers. When the company provided sales returns, they would have an expectation basically from the previous historical data. For example, I'm selling jeans, right? A pair of jeans is worth $100. But in the past, 5% people returned their jeans. So when I'm making the $100 jeans, I'll set aside $5, which is 5% of the $100, and say, okay, this $5 is set aside because I know historically 5% of people are going to return their jeans. So this money that we set aside is called sales return allowances. Sales returns and allowances. Here's an example. Let's assume the company made $2,000 sales. And from the previous history, the company knows that 2.5% of the customers are going to return the products. So 2.5% multiplied by the 2,000 gives us the $500, which we set aside as an allowances. This would be subtracted from the sales revenue and leading towards the sales return. So one question I got asked the most is, where does this return and allowances belong, right? Is it an asset account, liabilities account, or stockholders' equity account? Well, this account is called contra sales account, which is basically just the opposite direction of our sales. It works against the original sales amount and would reduce the sales amount to the net sales, which is from 2,000 to 1,500. Okay, now let's take a look at the reporting of net sales, which is an important measure, and I'll tell you in a couple of minutes why it's important. So we start with the total sales the company had made, which is $6,000. That has to be net of the credit card discount fee, $90. The sales discount, if someone pay us earlier, and that would be the $20, and also the return and allowances, $500, as we just indicated. So all these discounts and allowances account all of them are called contra revenue account or contra sales account. They work against the original sales revenue number and lead to the net sales number. Why is it important? It's important because net sales is always the first row on our income statement. So if you look at an income statement, the first row of the income statement is always net sales, which means it's the original sales subtracting all the discounts and allowances. All right. So for more details, you can watch the McGraw-Hill Guided Help video 6-1, which will talk about the net sales and gross profits. And this will help you to do your homework as well. All right, I'll see you in the next video.